This is Nightly Business Report with Tyler Matheson and Susie Garrett. Funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
Shake it off. That's what investors did today after global worries sent stocks sharply lower at the open. What today's turnaround may signal for your investments and your money.
New rules why the Federal Reserve wants to make it more costly to be a big bank.
And Rust Belt rebound. America's heartland is undergoing an economic transformation. But can this region, known for its manufacturing past, reinvent itself? We have all that and more tonight on Nightly Business Report for Tuesday, December 9th.
Good evening, everybody. Glad you could join us. Stiff losses, and then most of them erased. It started with China, then Greece. Worries about economic weakness, political turmoil. They unnerved investors around the globe today, and that worry spread to our own markets when the opening bell rang this morning. The Dow right out of the blocks, tumbling as much as 222 points, but then sentiment shifted. All those worries basically brushed off. By the close, the Dow was down, but just by 51. The Nasdaq rose 25 points, and the S&P fell less than half a point. Why the turn of events, and how concerned should long-term investors be about events happening overseas? Our Dominic Chu takes a look.
The holiday season usually brings the gift of stock market gains for investors, but the last couple of days have given some a moment of pause. Fresh worries from around the world seem to rattle U.S. stocks earlier in the day. For one thing, China's Shanghai Stock Index posted its biggest one-day drop in around 5 years as concerns about economic growth and new restrictions on the country's bond market roiled investors. And then there was Greece. Greek stocks had their worst one-day drop in over a quarter century on fears that upcoming elections could call into question the country's membership in the European Union. While the downside moves were dramatic, some experts don't believe they will have a lasting impact on our markets.
I don't believe that these events in Europe and in China are likely to escalate to the point where they have a material impact on our economy. And therefore, I think any effect that it has is temporary and should be used as a buying opportunity.
One other area that has a lot of investors concerned is the sharp drop in oil prices. Bulls point to lower energy prices as fuel for a new bull run. Lower energy prices help companies trim costs and boost profits. It also lets consumers pocket more savings that they'll hopefully spend, which also boosts the economy. But bears say that oil prices are low for a reason, because world economic growth is slowing, and some expect prices to keep falling.
There's a long history to energy prices way overshooting or undershooting any analyst's view on what fair value is. So we may continue to see some downward pressure for a while in the oil markets.
Still, over the course of the next year, many experts believe the bull run for stocks will continue, albeit at a slower pace.
We expect a single-digit return out of the markets next year instead of more, is that valuations have already come a long way. The market isn't cheap anymore.
Market risks from around the world will be a theme to keep an eye on for the foreseeable future. But whether or not they truly derail the markets is still up for debate. For Nightly Business Report, I'm Dominic Chu.
Joining us now for some more analysis, Alec Young joins us. He's portfolio strategist at Oppenheimer Funds. So, Alec, what's your take on today's market action? Was this something temporary, or is there something more serious going on?
I think we would view it more in the temporary camp. I mean, after all, the last couple of months, stocks have really done nothing but go up since that bout of volatility that we had in mid-October. So on a technical basis, we were a little bit overbought. We were due for some profit taking. So we weren't surprised to see the volatility, but by the same token, really not surprised to see buyers step in. After all, you know, over the course of the last few years, buying the dips has really been the strategy that's worked for investors, and they return to that today.
Do you think the U.S. market, Alec, is the place to be as we enter 2015 compared with other equity markets that I could consider?
Well, I think, you know, global diversification certainly has a lot of logic behind it. You know, that said, we do think that the outlook for the U.S., just given the momentum in our economy, and earnings is a little bit more certain than as we look around the world, but we certainly would encourage investors to, maintain global equity diversification.
There was a lot of talk today about oil prices, that they still continue at this very low level. We know that that is good news for consumers. Should investors be worried about an economic impact of these low prices?
Yeah, I wouldn't read too much into the low oil price as being sort of harbinger of doom in terms of the health of the global economy. We think the biggest driver of oil price weakness is really more on the supply side. The abundant amount of supply that's coming out of North America specifically, and some moves by OPEC from a market share perspective. So we're looking at it more as supply driven, really not a harbinger of negative demand. Certainly in the U.S., the economic data continues to improve. So we're looking at the glass as half full when it comes to energy. And obviously, it's a huge tax cut for not only the U.S. economy, but the global economy.
This morning in the Wall Street Journal, there was an article about what the Fed may say when it meets next week, and whether two words that have been in their reports considerable time will continue to be there with respect to when it may or may not raise interest rates. Do you think that played into today's action? And do you think the market is still and rightly concerned about when and by how much the Fed may raise rates?
Yeah, that's a great question, Tyler. I think definitely the notion that the economic data really has gotten strong enough that it's no longer justifiable to have that considerable period in there in terms of how long the Fed will maintain, very accommodative monetary policy. We do think it's likely that they'll drop that at next week's meeting. Where we might differ a little bit from consensus, at least among some investors, is in our view that, we really aren't as concerned with the timing of the first rate hike. We think that you have global deflationary pressures that are going to keep rates low for long. And while the Fed may be raising rates, we think it'll be at a very modest pace. And we don't think it's going to change this Goldilocks environment for stocks where growth is strong enough to drive corporate earnings, but not so strong as to trigger, really restrictive actions by the Fed.
We just have a few seconds left. Give us your quick outlook for 2015, given what you just said about the Fed and all these other global factors.
I think stocks rise, not as much as they have over the last few years. Rates stay low, and that's why investors need to look at a lot of different alternative asset classes for income.
All right. Good short answer. Thank you, Alec. Alec Young with Oppenheimer Funds.
Thank you.
Two stocks weighing on the Dow today were Verizon and AT&T. Verizon off more than 4%, worst stock in that blue chip average. AT&T down almost 3%. It wasn't just these two blue chips. The entire telecom sector is now negative for the year. Morgan Brennan explains why this group is under so much pressure.
Retailers aren't the only ones risking profits to attract customers this holiday season. Wireless carriers are doing the same, and the stocks are paying the price. AT&T warned that steep competition could result in more subscribers leaving its network this quarter. And number one carrier Verizon cautioned that holiday promotions will, quote, put short-term pressure on its wireless margins, sending shares notably lower. Analysts say Verizon's announcement in particular set off warning bells.
There is a general concern in terms of overall pricing pressure in the marketplace and the potential impact that it can have on the overall sector. And so when you've got, sort of one of the industry stalwarts indicating that they do expect margins to fall below their original anticipated levels for the fourth quarter, that is sort of impacting the overall view and sentiment on the sector today.
And competition is fierce. Last week, Sprint announced new price cuts to target the millions of Verizon and AT&T subscribers coming off contract this season. And T-Mobile has been leading the industry in subscriber gains. But there's another factor weighing on the sector as well: capital spending. T-Mobile tumbled today on its proposed public offering to raise more money for more investments. And the government's ongoing auction of wireless airwaves to the carriers has more than quadrupled the reserve price. That 1-2 punch, lower prices and higher spending, will make 2015 a transition year.
If you're looking at the overall telecom industry, for the near term, some of these issues such as pricing and the ability to fund some of these spectrum issues are probably going to overhang the industry for the next 12 months.
But that short-term pain could result in some major changes to the carriers' business models, starting with AT&T's acquisition of DirecTV. In the meantime, it's a great season to be a subscriber. For a Nightly Business Report, I'm Morgan Brennan.
The Federal Reserve proposes extra capital requirements for most of the most important U.S. banks, the ones categorized as global systemically important bank holding companies. The 8 banks include J.P. Morgan Chase, Goldman Sachs, Bank of America, Citigroup, Wells Fargo, State Street, Morgan Stanley, and Bank of New York Mellon. The surcharges will range from 1% to 4.5%. This proposal is aimed at lessening the chances of future taxpayer bailouts. The reaction was mixed among some of the financials, with J.P. Morgan, Bank of America, and Citi falling. Goldman Sachs rose fractionally.
2 of those banks, Bank of America and Citi, also told investors today to expect weaker trading revenue in the fourth quarter. The chief executives of both companies made the disclosures at a financial conference in New York City, and Kayla Tausche was there.
The Goldman Sachs Financial Services Conference is underway in New York, with bank executives taking the opportunity to warn investors about some weakness coming up in the fourth quarter. Citigroup CEO Michael Corbat announcing a $3.5 billion charge the bank will be taking. $2.7 billion of that will be related to legal matters like ongoing investigations into alleged currency and interest rate manipulation. Also, there's an investigation ongoing into anti-money laundering practices. $800 million of that charge will go toward existing repositioning at the bank. But in all, Corbat's telling investors it's unpredictable, especially where legal issues are concerned, because the leverage for pricing and for timing all lay with the U.S. government. Meanwhile, Bank of America CEO Brian Moynihan telling investors that trading revenues for the fourth quarter will be down compared to the third quarter of this year, as well as the same quarter a year ago. The main culprit there, ultra-low interest rates, yields that tested October lows. That is keeping traders on the sideline, and they do not want to play this volatility. The bright spot for all the banks presenting at the conference seems to be low oil prices. SunTrust CEO Bill Rogers says lower prices at the pump could save the average U.S. household up to $1,500.
It's essentially a refund, and I think that's going to have to impact consumer confidence in some way. I think we'll see it with increased spending. We'll see an increased use of credit card utilization.
The hope that higher confidence spurs consumer spending and could possibly lift some of the weaker businesses at these banks. For Nightly Business Report, I'm Kayla Tausche in New York.
Dow component Merck says it'll proceed with its $10 billion purchase of Cubist Pharmaceuticals. That's despite a court ruling which could lower future profits from Cubist's top-selling drug. Cubist makes the widely used antibiotic Cubicin for skin infections, but a federal judge invalidated 4 Cubicin patents today and ruled that Hospira can launch a generic version as soon as 2016, 2 years sooner than expected. Merck says it still expects the deal with Cubist to boost long-term earnings. Shares finished the day down 3% to $60.
And for another Dow component, the global economy isn't lifting off quite the way it hoped. Boeing says starting next September, it will build 2 fewer of its iconic 747-8 jumbo jets a year. The aircraft maker says the near-term recovery of the cargo market has not been as robust as it expected. Boeing adds the cutback is not expected to have a material financial impact.
Still ahead, what are people doing with all the money they're saving on gas? The results of a new survey on spending and the economy coming up. More evidence that the employment picture continues to brighten. In its monthly JOLTS report, the Labor Department says job openings rose to a nearly 13-year high in October, and there were more people leaving jobs than in more than 5 years. This so-called churn rate is closely tracked by the Federal Reserve, engaging the overall health of the job market. But the Labor Department adds the number of people actually hired for new jobs was not much changed from September.
Well, many of America's jobs, of course, in smaller businesses, which, if they grow bigger, normally create new jobs. And last month, small business optimism surged to its highest level in nearly 8 years. It is the latest indicator the economy is ready, perhaps, for faster growth in 2015. The survey found that owners are very, very bullish about business conditions over the next 6 months, but they continue to hold back on capital spending and on hiring.
But most Americans do seem more bullish about their own piece of the economy. Steve Leisman tells us about a new survey with a lot of holiday cheer in it.
Americans plan to spend more on gifts this Christmas than in any holiday season in the past 5 years as economic optimism hits a post-recession high. CNBC's All-America Economic Survey finds that the average American plans to spend $765 this year on gifts, up 12% versus last year, and about 6.5% higher than the average across the survey's 9-year history. Behind the Yuletide cheer, an improved outlook for expected home values, wage gains, and the stock market, all at or above their highest levels since the 2008 financial crisis.
As we see people's perceptions of the economy improving in terms of their wages, in terms of their home values, in terms of their views of the U.S. economy writ large, we also see their spending on holiday gifts going up. This can create the perception of a perfect storm where people's views of the economy perhaps have more staying power than we've seen in the past, as they're using their credit cards more, as they're spending more, and as they see the economy improving over the long term.
Lower gas prices also seem to underpin American optimism, although just 8% plan to spend the new windfall. 13% say they'll save it, and 12% will use it to pay down debt. The rest don't plan to change anything. But the main question is whether this surge in optimism will last.
Hey, how we doing? Good, how are you?
Previous bumps have faded away over concern, for example, over the government shutdown or economic troubles in Europe. But this time, some of the gauges are not just taking out the best numbers since the crisis, they're nearing the old normal, or the level before the recession. That creates some hope that the better numbers could be here to stay. For Nightly Business Report, I'm Steve Leisman.
We begin tonight's market focus with the plummeting shares of Conn's, the electronics and appliances retailer. Disappointed investors after reporting a quarterly loss also withdrew its 2015 profit forecast, and it said its chief financial officers quit. The company said its mainly low-income customers are struggling with credit payments. Shares there of Conn's down 40%, lost $14 today alone. It finished at $20.83. Rough day. Positive trial results sent shares of Bluebird Bio the other way. The stock soared on news that 4 patients transplanted with its product that treats a genetic blood disorder were essentially cured. That prompted several firms to hike their price targets, and the stock took off. Shares of the company surged today by 72%. They closed at $84.28. Investors bought up shares of Abercrombie & Fitch on news its CEO, Michael Jeffries, would retire effective immediately. The teen retailer's chief will be replaced by a team led by the former Sears head, Arthur Martinez, who is now executive chairman there. The move comes as the company has been struggling with sluggish sales. The stock up 8% today to $28.46.
AutoZone reported better than expected first quarter results. The auto parts retailer said lower gas prices and colder weather encouraged customers to get their cars ready for a harsh winter. Shares rose 4% to $605.81. Spirit Airlines disappointed investors, saying its load factor fell in November compared with last year. Raymond James downgraded the stock to market perform and removed its $85 a share price target. Shares fell more than 12% to $73.77. And Valeant says it's abandoning its acquisition strategy to try to reduce debt and boost its stock price. The Canadian drug maker has spent almost $20 billion on acquisitions since 2008, and it's regrouping after failing to acquire the Botox maker Allergan. Shares fell 2% to $141 even.
A new audit by the Treasury Inspector General for Tax Administration shows the IRS paid at least $6 billion in improper tax breaks. The payments were refunds to families that incorrectly claimed child tax credits or claimed the wrong amount. They also went to fraudsters. Millions of low-income families qualify for the child credit even though they don't make enough money to pay federal income taxes.
Well, no financial credits for a group of Amazon warehouse workers. The Supreme Court has ruled that the retail giant doesn't have to pay those workers for the time they spend at security checks as their shifts end. The decision was unanimous and is a victory for the growing number of companies which routinely screen employees to prevent theft, Some Amazon workers claim they wait up to 25 minutes to get through security.
Well, the clock is ticking. Midnight Thursday is the deadline now to get a spending bill passed that will fund the government and prevent a shutdown. It is the main piece of unfinished business before Congress heads home for the holidays. John Harwood reports from the White House North Lawn tonight. John, are the negotiations moving any closer to a deal?
They are, Tyler. You can never underestimate the capacity of Washington to mess things up at the end, but it does look like they're on track for resolution. The House is nearing completion of its bill, which essentially funds the entire government through a negotiation between Democrats and Republicans through the rest of the year, the fiscal year, except for the Department of Homeland Security. That's in protest to the president's immigration action. Republicans are only willing to fund that through February. Looks like the House is going to vote that on Thursday. The question is whether the Senate can get it done by the weekend.
Well, will the House pass it, John?
I think they will. Originally, Democrats said they were going to withhold their votes and they were going to require Republicans, because of this protest against President Obama's action, to pass it entirely with their own votes. Now it looks like there'll be votes from both sides to pass it. There may have to be a temporary extension of the midnight deadline that Tyler mentioned for a couple of days, because the Senate may not be able to act on Thursday, but we do expect the Senate to act perhaps as early as Friday, maybe early next week.
So really no chance of a shutdown, I hear, by listening to what you're saying, John. What about the separate matter of some tax break extensions that were much talked about a week ago? Where do we stand on that?
That's going to be resolved. The House has extended them for the rest of the year. Think about that, Tyler. We're 3 weeks away from the year. They've now enacted an extension through 2014. How's that for planning ahead? The Senate has not acted, but we do expect them to wrap that up before they get out of town. There's also a last-minute dispute over terrorism reinsurance provisions, which arose after 9/11. There's some debate between Republicans and Democrats. Jeb Hensarling, a prominent Republican in the House, wants to enact some changes to Dodd-Frank as part of that. Democrats are resisting, but it looks like they're going to be able to resolve that disagreement as well.
All right, John, thank you very much. John Harwood reporting tonight from Washington. And coming up, an economic rebirth is taking place in America's heartland. Tonight, we head to Cleveland, a city in transition and one that may soon look a lot different from its heavy manufacturing past. The first of a two-part series next. Detroit is set to exit bankruptcy tomorrow. The city, which filed for the biggest ever municipal bankruptcy back in July of 2013, won approval from a federal judge last month for its plan to shed billions in debt. And today, the Michigan governor's office accepted the Detroit emergency manager's declaration that the city's financial emergency is over. An official announcement will be made Wednesday.
The region known as the Rust Belt has been a symbol of American decay as manufacturers fled the economy and the economy weakened. But today, the area is enjoying a renaissance of sorts, thanks to new industries like biotechnology and old industries retooling for a new economy. Scott Cohn reports tonight from Cleveland for the first of a two-part series.
When design firm SmartShape started in Cleveland in the 1980s, rubber and plastics were still king, and that shaped their business.
There was a lot of plastic manufacturing in Cleveland, all kinds of houseware products, baby car seats and things that were made in the Cleveland region.
Now more than half their business is related to health care.
We help our customers design new products, innovate and create new and better products.
Like this device that can insert a wire into bone in orthopedic surgery. Healthcare has picked up where heavy industry left off.
So while we were losing some types of industry, we were very fortunate that this has stepped in Cleveland.
In 2000, Ohio had more than 1 million manufacturing jobs and about 600,000 in healthcare. Today, the figures have just about flipped. John Kasich is Ohio's governor.
Our DNA is in manufacturing. But we know that what your old man used to do is not what they do in manufacturing today. I'm excited to recruit the new industries, to help build the new industries, that are powering America into the 21st century.
But there could be problems ahead. Unemployment here is now below the national average, but Ohio has only regained about half the jobs it lost during the recession. And health care is not the economic driver it once was, in part because of the Affordable Care Act. That's because health care reform is supposed to be about cutting costs. At the world-famous Cleveland Clinic, which injects $12.5 billion a year into the local economy, they cut 1,000 jobs this year. And CEO Toby Cosgrove says there's more cost-cutting to come.
We're trying to just drive the efficiency, and the efficiency really now is coming around how we actually take care of people.
At SmartShape, they hope the new focus on efficiency creates more demand for smart design, good for their business. But it means the future of this Rust Belt rebound is far from clear. Scott Cohn, Nightly Business Report, Cleveland.
Scott continues his series tomorrow with a report from Youngstown, Ohio, another city that fell on hard times but is now returning to its manufacturing roots thanks to the domestic energy boom.
And finally tonight, President Obama says everyone should learn a little code to be ready for the new job market. And now he has become the first president ever to write a computer program. It's a modest one, okay, but it's a program. The president worked with middle school students completing some of the exercises. He wrote a single line of code. Love the lid there, Mr. President, using the common programming language JavaScript. The organizer of the coding tutorial said the president was very precise and didn't make a typing mistake. Insert your own joke here.
We can keep
it's the first time he hasn't been criticized in weeks. All right.
That's Nightly Business Report for tonight. I'm Susie Garrow. Thanks for joining us.
And I'm Tyler Matheson. Have a great evening, everybody.
Nightly Business Report has been funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. On Wall Street today, steep losses and then most of them erased. It started with China, then Greece. Worries about economic weakness and political turmoil spread to our markets, with the Dow tumbling as much as 222 points. But then sentiment shifted. By the close, the Dow was down by only 51 points. The Nasdaq rose 25. The S&P fell a fraction. The Supreme Court has ruled that Amazon doesn't have to pay warehouse workers for the time they spend at security checks as their shifts end. And some good news on the job market. In its monthly JOLTS report, the Labor Department says job openings rose to a 13-year high in October, and there were more people leaving jobs than in more than 5 years. Be sure to tune in to Nightly Business Report right here on your public television station.